All right, guys, thanks for joining us today. This option workshop is going to be on long call spreads. And although it may seem like a very simple beginner type of strategy, I'm going to go through 3 different ways that we can set this up. And for that reason, I'm going to go through all my rules of those. And this is being recorded. So one thing I say that at the beginning of all of these is watch this again, you guys, because some of the nuances of these different strategies within one strategy can fly by you, especially if you're learning or some of these concepts that I'm going to be putting forth to you guys are new. So watch it again because it'll make it really sink in. If you wait a month down the road, you're going to be watching it and learning it all over again. But if you watch it relatively soon after, within a couple of days, it'll make it sink into your long-term memory, and you won't have to necessarily watch it again and again. All right, so like I said, this is going to be on the long call spreads. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical market analysis. I actually started out trading in college with a psychology degree, believe it or not, with some money I had earned, and decided to switch it over to finance. And after graduating with a finance degree, I moved to Chicago and started as a runner on the floor of the Board of Trade, and then moved into the pits shortly thereafter. But in that entire time, from college to now, I've been trading everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. So I've been trading well over 25 years now, or not well over 25 years, but about 25 years now. Got to go over this disclaimer really quick. Any opinions, news, research, or analysis, or other information contained here or material provided by ProTrader Strategies and associate companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies we're talking about. The reason why I can't do that, you guys, is because I can't possibly know what's in all of your portfolios and what your risk parameters are and things of that nature. And those are things that somebody really needs to know the intricacies of your portfolio before they can possibly give you any recommendation as to what you should be trading. So this is for educational purposes. It's to teach you guys how to swim, in a sense, rather than to swim for you. So take what we teach you in these webinars and apply them to your own portfolios within your risk parameters and in your own way. Bottom line is, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. How doing, Trevor? Thanks for the shout out. One other thing is you can follow us on Twitter. You can follow me personally at Wolfman's blog, and you can follow ProTrader Strategies at ProTrader Strat. I usually give out some snark here and there and some personal stuff and snark, and ProTrader Strategies gives out some really good investment advice and a lot of deals and stuff like that associated to other webinars as well as mine. So you can follow us both on Twitter. And I usually, since we're out of earnings, it's not going to happen so much, but usually if I do an earnings play, I'll throw that out there on Twitter as well. So anyway, this is how to build a long call spread. And like I said, yes, that does seem like a pretty easy strategy to build out in a sense, but I'm going to go through several rules to make sure that it increases your probability of success with this. So it is a low probability strategy, but I'm going to show you different ways that you can build this out to increase that probability of success with it, and hopefully kind of turn the tables slightly in our favor. Anyway, so building a long call spread, at the end of the day, a lot of people think of this as buying a just maybe out of the money call and then selling a further out of the money call. I usually like to play around with the ones that are at the money, and I even look at the ones that are in the money and, you know, relatively deep in the money as well for setting up this strategy. If I'm picking one that's in the money, kind of looking somewhere between like usually I start with like an 84 delta in the money call. Now, the reason why I do that and then sell an out of the money call, the reason why I set it up that way is it really kind of starts acting more like you are long the underlying in a sense. It's a synthetic collar. And have any of you guys ever traded a collar or know what a collar is? A collar is when you get long the underlying stock and you would buy a put and then sell a call to like finance it. So you limit your risk to the downside and you kind of cap your upside potential with that. But you know, the real reason is you kind of want to limit your risk to the downside. When you're buying this 84 delta call, you're really building out a synthetic collar in a sense. No, you don't get to keep that stock if it doesn't go anywhere because the options are going to go off the board. But if the market moves up, it's going to act just like a underlying with a long put and a short call against it. The deltas all work out and everything else. So that's why I kind of like opting for that to start out. It's usually when you're buying that 84 delta call and selling a call out of the money, your directional assumption with that type of strategy is more market neutral to bullish. Now, the further you move up the montage and you're doing an at the money call and then selling an out of the money call, that's more bullish. Like you are a little bit more bullish with your market assumption. If you are buying an out of the money call and then selling a further out of the money call, you are what I would consider almost wildly bullish in this underlying because there's a lot of risk involved with that. So when we're setting it up like this, where we're doing an in the money call or an at the money call, which the in the money call is usually shoot for the 84 delta, the at the money call is the one that is right at the money. These we're going to be paying a debit for. This strategy, we're always paying a debit, but our spread width needs to be about risking one to make one. So in that regard, if it was a $5 wide long call spread, we'd be looking to pay somewhere around $2.50 or less to make $2.50 or more on this strategy. If I was picking two out of the money calls where I was buying an out of the money call, maybe one or two strikes out of the money, and shorting an out of the money call further higher on the montage, then I'm going to be looking to risk one to make two in a sense. And in that, if it was say a $3 wide strategy, then I would be looking to pay $1 to make you know, $2 on that. So you're risking one to make two. So pay a debit of $1, you'd be risking on a $3 wide trying to make that extra $2 that's there. Now, that's not exactly where I'm going to close this strategy out because just like with this strategy, I'm trying to play the probabilities, and if I beat the probabilities, that's when I'm going to be looking to close this out. I'm not going to look to ride this out into the sunset and try and make my full boat on it. If I beat the probabilities, I'm going to be looking to close out. So keep that in mind, and I'll go into some of those details a little bit further. Also, when I'm setting this up, I usually, you know, I'm being a contrarian, which means when the market's going down, I'm looking for it to go up. When the market's going up, I'm looking for it to go down. Now, so I'm kind of counterintuitive in that sense. So with this strategy, I usually like to really look around underlines that have had like a 10% correction in that underlying, which means, you know, maybe they've kind of rallied up pretty good and then they've come off 10% from that. So like a $100 stock, 10% correction would be about a $90 move to the downside. That's when I'm going to kind of look to start setting this strategy up. Now you can also set this strategy up around Fibonacci levels or technical analysis and things of that nature, and I do that as well. I'll talk about that a little bit further on when I'm looking to cover that strategy, but this is how we're looking to set this up. I've got a couple questions already. So how far out of the money? What delta for the short? Trevor, great question. I'm going to hopefully answer all those questions here pretty soon when I start going through the list. And can you show us both risk 1 to make 1 and risk 1 to make 2? Yes, when we pull up the platform, it'll be a little bit easier. I like to do those on the platform, so we'll try and set some up like that. I think I got a couple of good ones that we can do that with, or at least very close to it anyway. All right, so kind of went over this already. Picking the right strikes. For me, I like to start out with that 84 delta if I'm market neutral to bullish. If you're really bullish, then you're going to be picking the one that is closer to at the money. But keep in mind, picking those right strikes, it doesn't just account for the one we're getting long. I mentioned on the risk 1 to make 2, if you're that's part of picking the right strikes. If you're going to buy the 84 delta strike that's in the money and selling out of the money, then we're looking to risk 1 to make 2. So that's how you're setting up those strikes in order to determine whether or not this strategy is going to be appropriate. It's probably not the right word, but if you're setting this strategy up to increase your probabilities of success. The other thing is, if we're buying the out of the money call and selling a further out of the money call, then we're looking to risk 1 to make 2 in that sense. So make sure when you're playing around with those strikes that that falls in line with this first part to set yourself up for success. Because one of the major things that we can do to set ourselves up for success, you guys, is on order entry. So make that a major note. You know, there's a lot of things that go on after we put this strategy up, but one of the major things that we can do to set ourselves up for making money is to set this up correctly. All right. Sorry, Ed. All right. The next thing is picking the right duration. Now, this is pretty important, especially like right now we're kind of in this area where we are seeing a lot of theta decay, which is time decay, coming out of our options, and that is in the March. So we're going to be looking at something a little bit further out in the April area. So this is kind of our sweet spot for this strategy, or at least for me. You get way out here, 100 days out, you're going to end up paying a lot for this strategy, and I usually don't look to have something on that long, but I do want myself to have enough room to be right. The longer we can be in this strategy, we're increasing our probabilities of success in a way, because the market could come down and it gives us a lot of wiggle room on our timing. If we're doing it in here, we're fighting this theta decay, and it's going to we need to have a quicker move in order to counteract this theta decay coming out of our options premium. But if we can get out here, we have less theta decay, and it gives us a little bit more time to be right. Then picking the right environment. With this, anytime you're doing a debit spread, I don't care what kind of debit spread it is, you want low implied volatility, because if volatility expands, even if you're directionally wrong, it can help you out. Trevor's asking, somewhere between, I would even say 70 to 30 days. No, I would say, outside of 50 days is where I'm looking for this strategy. I mean, 55 days or more would probably even be better, because then it gives us, 10, 15 days to be right before we really start getting that theta decay happening. So somewhere between probably 55 and 75 days is kind of like the real wheelhouse that I'm kind of looking at. Then the right environment is, we want low implied volatility, because as an extreme example, in 2009 when we saw the crash happening, 2008 and 9, we saw volatility really expanding. So people were actually selling calls in that environment, and with implied volatility expanding, they were directionally right and were still losing money. And you will see that if volatility expands quickly, even in the short term, that that volatility, if you're just selling strategies, volatility expansion can still hurt you even if you're directionally right. So with this being the opposite of that, we are looking for, if volatility expands, if we're directionally wrong, we can still have an opportunity to get out when we are directionally wrong. So keep that in mind. We want low implied volatility. ETFs, I want something lower than like a 15 IV%, and for regular stocks, I want something less than 30%. You know, the lower the better, because then the lower the probability, or the lower the implied volatility percent is, the probabilities are that it will expand for you going forward. So if you're doing this around a 50 IV%, I would look to, or if you wanted to really trade a directional underlying or a directional assumption with an underlying, then I would look to use other strategies around that. But this is something that we found an underlying. It's got lower than 30% IV%. That would be the time to do something with this long call spread if we were neutral to bullish on it. And picking the right underlying, I say this time and time again every webinar because I think it is extremely important. Maybe not as important as with something like the butterfly, where there's really multiple legs in there, like 4 legs in a sense, or the iron condor, but it's still very important, because the more participation in the underlying that you're trading, the more opportunity you have to get out without having to give up too much edge. Keep in mind that if there's a wide bid ask, you got to give up a lot of edge to get in, you got to give up a lot of edge to get out, and that's something I don't like to do. So if there's a tight bid ask, you know that even when things start getting crazy, if the market starts moving rather quickly, there starts to see some volatility in there, there's going to be players in there. If you're picking something with wide bid asks, the fact of the matter is those people are going to leave that underlying and go to the most liquid market, which is hopefully where you were to start. You know, if you are a really savvy trader and have been trading for years and years, then you know you can bend that rule a little bit. But the rule for this is $100 stock or less, we're looking for a bid ask of inside of 10 cents. If it is over $100, the easiest way to kind of get your ballpark figure on how wide that bid ask should be is take the decimal point and move it 3 ticks to the left, and that's how much you should be seeing the bid ask differential. So that being said, a $300 stock, if we move the 3 ticks to the left, it should be 30 cents to the bid and ask. That's how wide it should be. $1,500 stock, 3 ticks to the left, that bid ask should be right around $1.50. So that's just kind of your ballpark figure on those when they get above. But anything below $100, make sure it's inside of 10 cents. All right, unless you trade that stock a lot, you know, we used to also say on the floor, there's some things out there where there's traders in the weeds. They like to trade it a lot. Tesla has a tendency to sometimes get wider bid asks than that rule, but there's so many players in there on any given day that you don't really have to go to the mid price to actually get filled. So keep that in mind as well. And another thing, when order entry being the utmost importance on a trade, you know, it doesn't cost you guys anything to set up a strategy where maybe you're on the offer, or in this case, we're on the bid, and then ratchet that bid up closer and closer to the mid price in between. Over time, if you get better fills, that's going to increase your yield. But the worst feeling in the world for me is I put a trade in and boom, I get filled. Because that means I probably gave up a couple of pennies. Yeah, no, it's not going to mean that much for that particular trade, but over the course or your lifetime of trading, those little pennies will add up to dollars and $10 and so on and so forth. And that ends up being a lot of money. I mean, it ends up, if you can make a couple extra pennies on every trade, it helps you finance your commission costs. So it doesn't cost you anything to put it in an order, let it sit for, I'm not saying 5 minutes, but let it sit for a couple of seconds. By the time you put that order in, hit confirm and send, and by the time you go back in there, change and adjust that price to send it out again, doesn't get hit. By the time you change it, that's the amount of time I'm talking about. You don't have to spend and sit there and wait 10, 15 minutes before you go and change that. Just put it in and let the algos kind of give you a better fill. So just work the order a little bit. And know your exit strategy before entering the trade. This is also very important. The reason why it's important to know your exit strategy, especially for me, is it keeps you mechanical. It takes a little bit of the emotion out of this trade. You don't start second guessing yourself. All right, well, this worked out really well right away, and because it's going my way, I'm gonna let it ride a little bit longer. If you know your exit strategy, you have it, written down, you have it on a sticky note on your computer, you're more likely to cover that trade when you're mechanical rather than when you're emotional. So be mechanical about it. Don't look back. Don't ever go back and say, well, if I would have legged out of it or I would have just kind of let it ride, I would have been better off. No, if your gut's telling you, get out of it, for one, get out of it. Two, if it mechanically fits, you're beating the probabilities. That's the way I set this up. On order entry, I have it set up where if I'm beating the probabilities, I'm getting out, because the probabilities, if you let it play out, are going to come back and bite you in the rear end. So get out, stay mechanical. Once you know you beat the probabilities, that's the time to get up and walk away. Pull the ripcord. So in that, if we were to choose that collar type synthetic collar strategy that I talked about, where we're buying the 84 delta call that's in the money and selling a call that's out of the money, I'm going to be looking to exit somewhere around a 33% profit. So what you can do easily on order entry is just multiply it by 1.33, and that tells you exactly where your pricing is. So in that, the one example I gave was a $5 wide, which is a little bit narrow, but just for math purposes. So basically I paid $2.50 for this strategy. It's a $5 wide, so I'm risking one to make one. Well, multiply it times 1.33, and that tells me I'm looking to get out when this is profitable and I can sell it for $3.33. Okay, so does that make sense? That's on the one that is deep in the money. Now, the one that is out of the money and I'm looking to make one, to risk one, I'm usually looking to take about 50% of that. So in that one example, I paid $1 to make $3 in a sense, or it's a $3 wide, so I pay $1. My profit potential is an extra $2 to get that full width. Probably going to be covering this when we're at $2. So that's 50% of my max profit potential, which is 50% of $2 is $1, right? So if I can cover it for $2, then that's where I'm looking to get out. Or if this happens to go up and hit my short call, if it goes up and touches that short call or blasts through it, then I'm immediately starting to get in the mode of covering that trade. I don't care if it meets those parameters, that supersedes, because the likelihood that, for instance, on the collar trade where we're buying the 84 delta call and you're basically selling a 16 delta call, that means I have a 16% probability of that short call being touched. That means if the market comes up and hits that 16 delta call, I have crushed the probabilities. And I am looking to pull the ripcord as soon as I can on something like that, you guys, because the last thing you want to do is see that probability play out and that short 16 delta call comes back out of the money, and we go back to where we initiated this strategy, and it's going to be a loser. So those are the parameters. You know, you're looking to get 50% of your max profit on the at the money with the further out of the money call, the synthetic collar, which is that 84 delta in the money call and a 16 delta out of the money call. That one I'm only looking to take about 33%, because remember, when I put that strategy on, I'm kind of neutral to slightly bullish. So in that, if I can get 33% of my max profit on there, I'm looking to get out. But if it happens really quickly and it goes up and touches my short call, just in about any scenario, I'm looking to cover that strategy right away. And if you pick that synthetic collar with the 84 delta and the out of the money call, that's usually going to be real close, if not better than that 33% width, or 33% of the max profit potential. So keep that in mind as well. In terms of cutting losses, do you take the entire spread, expire worthless, or would you cut your losses or defend it? Well, one of the problems with this, let me answer, Luke, one of the questions here. Do I try and defend this strategy? I don't try to defend this strategy. I will cut it for a loss, and I was about ready to go into that. So if we set this up with just an assumption for, you know, I have a bullish assumption, and I start losing a little bit of money on it, I'm probably more inclined, especially with that 84 delta and the 16 delta synthetic collar, if you will. I'm more inclined to hold on to that one, because I'll go into some of those reasons, but basically I'm paying for all the extrinsic value in that strategy when we set it up that way. So I'm more inclined to hold on to that one. If I'm wildly bullish on this one, maybe because of a technical setup, the way, you know, we looked at the charts, we see like a hangman doji at the bottom of a, you know, a big move. We've had a 10% correction, and all of a sudden you've got like some kind of candlestick down there or pattern that you're looking at. Okay, well, now I'm bullish in this. Then I would probably cut my losses as soon as that chart setup was broken. Maybe a Fibonacci level, I was kind of like pinning it on, you know, if it gets below that Fibonacci level, you know, then your strategy or your setup has been broken, then I would look to get out. So that's how I play it. If I'm going off of an assumption on, you know, more of a stock, like I'm bullish the stock because of fundamentals maybe, then I'm going to look to let that one play out a little bit further. But if I'm doing it strictly as a technical setup, then once that technical setup is broken, then I'm covering it, getting out for that loss. Does that answer your question, Luke? So in that regard, if it's not really working out, I'm playing it those two different ways. And you know, do it according to your the way you trade too. You know, if you are strictly a technical analysis trader, then I would, as soon as that pattern's broken, I would get out. It's done, right? Just like that's your synthetic stop, right? And if you are more of a fundamental trader where you're looking at the stock and I really like the stock and things of that nature, then I would probably hold on to that a little bit longer. Kirk, if we are going long and short, doesn't it offset the theta? Would we not be theta neutral? Yes, Kirk, yes. In a sense. So the ones that what we're going to try to do, especially with the one that's the 84 delta in the money and the 16 delta, we're going to try and offset all of that by paying for the extrinsic value, which is all theta, right? But if you're buying one that's closer to at the money and one that is further out of the money, the theta decay is going to happen at a faster rate on that further out of the money than it is the ones that are closer to at the money. Okay, so we're trying to you're playing that game in a sense, so you got to worry about that still. They do offset each other a little bit, but especially if you're buying the one that's closer to at the money and the other one, they're gonna decay, but they're gonna be decaying at different rates. Why not buy a call or a put? In this strategy, to buy like a put, you've got a synthetic put already embedded in this, in a sense. With when you're buying that call, you're only limited to as far as that long call. If the market goes below that, you're not at risk anymore. Right. So that's what I'm saying. Why not buy a call or a put to defend it? So you've already gotten a long put kind of embedded into this. That's why I was kind of trying to correlate that to the collar, where it's, if you're buying the 84 delta call that's in the money, it's in a sense like you've gone out and bought that stock. You bought XYZ stock, and then you also bought a put, all right, at around where that 84 delta is. So that would be your synthetic long put in there. So why not just add another put to it or something like that? Because you're kind of, in a sense, you're increasing your risk by buying that put, and you're also, I look at it like you're throwing good money at bad money at that point. So I kind of let it play out. You could be assigned. You can't be assigned on the long call that's in the money or at the money, however we set that up. You can't be assigned on that. Yes, you could be assigned on the short call if it blasts right through it, but most likely I'm not going to be in that situation, because that's when I'm looking to cover the strategy, because I've beaten the probabilities. I'm not going to get, I mean, the likelihood is I'm not going to be assigned unless this happened, you know, within 3 days or whatever. But you also have that long call that's way in the money now, and you can just assign somebody on that. I mean, of course, we're talking about higher commissions, but you can offset that by getting long much lower than where you're forced to get out, or where you're handed those short underlyings. You can just hand your underlyings to somebody else, and you still make that difference, right? Because you bought it much lower than where you were short the stock. Somebody assigned you on it. Does that make sense? All right. So max profit on this. Anytime we're doing max profit, it's going to be the short call minus the long call minus the premium paid. That's your max profit on this. So basically what we were talking about is the width of your spread, whatever the width of that spread is, minus the premium you paid. That balance is your max profit. Your max loss is that premium you paid. Anytime you do a strategy, an option strategy for a debit, that is your max loss. Always. Anytime you pay a debit, max loss, you know it immediately. Your break even is going to be that long call plus the premium you paid. Now, another reason why I like to set this strategy up with the deeper in the money call is because when I'm selling a call against it, I'm trying to finance all of the extrinsic value that's there. And that leaves me with legitimately buying that underlying where the current market is trading. So without further ado, let's pull up the platform and I'll show you all of those things there. So this is usually when I kind of throw it out to you guys. We want something with low implied volatility, kind of like Starbucks, I guess. Since it's up here, it does have low implied volatility, and something we're bullish. So start throwing them out there, and we'll start going through these stocks to see if we can find a couple of strategies that work with it. This is the implied volatility. You can see it's really low. I also throw it over in my watch list and is the first thing I look at, even before I look at what the underlying is. I'll just basically go along like this and start clicking on it and see, I wouldn't really necessarily want to do Southern Company because they've already had a big rally, and I'm a contrarian. But if you're one of those, if you're a person that thinks, well, it's going to continue, then Chesapeake could do it. But I've got a couple of people throwing them out already. All right, we'll do. I don't know if I've even heard of this one. JQ, what is it? ISRG. Sorry, I probably should put my glasses on. All right, Intuitive Surgical. I actually have heard of that, but I don't trade this very often. They do have really low implied volatility. They've had a nice big run. If you are still pretty bullish on it, then I would go into the trade window somewhere outside of 50 some odd days. We're right there in the wheelhouse. It is a $700 stock, so this is what I was talking about. Move it 3 ticks to the left, and we're probably looking about 74 cents wide before it fits my rules there. And we're looking at like $3 wide. So this is, and the other thing is, the deeper in the money you get, usually they'll get a little bit wider. It's probably not going to fit my parameter because, you're going to have to give up $1 this way to get in at least. And then when you try and get out, you're going to have to give up $1 to get out. So JQ, I would probably stay away from this underlying. Plus, if you're going into the 84, I just would probably stay away from this for trading options, to be quite honest. If we looked at the volume and open interest on here, you can see there's pretty good open interest, not a lot of volume on a daily basis. That means when the going gets tough, these are already $3 wide. When things start getting wanky, these are probably going to be $5, $6, maybe even $10 wide. So it's something, I think it's a little too wide. All right. Yeah. Okay. It is a little wide. But if you're comfortable trading that one, that would be up to you. That's a really high risk one. So URI. United Rentals, so it's $120 stock. We'd want it to be around $12 wide, and this is another one. So it's $1.30. So you're going to have to give up a lot of edge to get in and get out of this one. So it wouldn't work for me. I like them. I'd want this to be at 10, 15 cents wide. So we could look at something like even Facebook. That I don't know what their IV percent is, but it's around that same pricing, right? And look at this, we got 6 cents wide. So that's something I would look at. And then you start looking at the 84 deltas, you'll start seeing it. And that rule that I'm talking about is usually just look at these ones that are just out of the money, because obviously the deeper in the money you go, that rule doesn't necessarily apply. But having said that, you'll be able to see that there is a lot of volume and open interest in those ones that are in the money. So you won't have to give up much edge to get in and get out of this. You might have to give up 10 cents edge, but you're not going to have to give up that full 35 cents to get in and out of these ones that are in the money. So Facebook would work quite nicely depending on what their ID percent. It's 27, so that fits just in there. And I don't mind doing this strategy when there is an earnings event coming up, as long as it's not like within the next couple of days, because ID heading into earnings events, as you can see, will generally speaking continue to expand for you, which is good. So we want that volatility to expand after we put this on. I would not hold this strategy on, especially if it was a winner. If it was a complete loser, then I'd probably just hold it because it doesn't matter, right? But if it was a winner or even a slight winner, I would get out before that earnings, because this volatility crush will really hurt you. So get out if you've been long and you're right before that earnings event. If it's a total loser going into it, you've got nothing to lose, right? Because if you had on the losing put spread through all of this and then waited for the earnings event, that could have been a winning trade immediately, and the volatility would have been hopefully counteracted by the directionality. All right, so does anybody else have any others? We can look at well, let's continue with this one anyway. So the different ways to set this up. So we're looking at the delta. So we're looking at the 84. This is what I'm talking about. The reason why is because it's one standard deviation away. It has an 84% probability of being in the money at expiration in the next 56 days. So that's a high probability trade. Then when we're doing this strategy, if we were going to start with the 84 delta, because I'm kind of maybe neutral to slightly bullish with Facebook, we're going to go buy this one, all right? So we're going to buy that 125 call. And then here is a floor trader hack, little quickie for you guys. Anytime you're doing in the money options, you can go through and figure out, do the math. Okay, well, it's 11, what are we paying? 1170. So let's just say 1160. You add 1160 to 125. So that gives you 136.60. Subtract that from the where it's trading. That's extrinsic value, right? Well, here's the floor trader hack. You just look at it and forget about all the math. It's done for you. The corresponding put gives you a really close ballpark figure as to what the extrinsic value is, and that's what we got to pay for. So we're trying to pay for this extrinsic value that's embedded in here. So in that, it's going to usually be the one standard deviation out of the money. We pick the one standard deviation in. The 16 delta is the one standard deviation out. This is about as close as we can get to that. So that's where we would want to sell it. So if you do the math now, you can see that it was really close. It was a little bit off. And some of that could be a dividend coming out. That's another thing, is if they have a dividend coming out, doesn't look like it. But if they have a dividend coming up, that could be what the difference is the options are pricing in a dividend as well as the extrinsic value, because it's going to come out of those options. Or the market's going to go down by that much. So they kind of price that in a little bit. So as you can see, if we just add the 1058 in there, we get 125.58 or 135.58. So that's really close to where that underline's been trading. So it's off by a dime or something. So that's what we're trying to do, because then when we initiate this strategy, hold on. I'm going to do it as so it's easier on the math and everything. So when we initiate that strategy, you can see that our break even is 135.58, which is where I was saying. We want our break even to be as close to where the underlying is trading. That's our goal for when we're buying this synthetic collar. So we don't have to have much movement at all. This theta decay, I think Kirk was asking, well, are they going to counteract? This theta decay will completely counteract with this theta decay, because they are both, very close to the 60 delta. So you're going to see that their theta is going to decay at about the same rate. So that's what we kind of want. All right. And this is what I was talking about with the theta decay on the difference in the theta decays. So you can see as you go out, they're going to change. So that's going to be a little bit different when you're picking the at the money ones. And that could ultimately hurt you. All right. So, but one thing we didn't check was we have $10 wide, or sorry, we have $20 wide on this strategy. We want to pay around $10. This is slightly over what that is. So, I might hold on to that. It's kind of not fitting with that risk one to make one. It's very close, but ultimately I'd like to get this to be risk one to make one. All right. So yeah, LD is the next one. Gilead. Barb wants Gilead. So let's look at that. It's got really a low implied volatility. Let's just say we've got a directional assumption. I actually really kind of like this because it has had some bad news. I always say when we're trading market profile, especially if this market came back up and settled inside of this little line here, that would be really bullish for me for sure, because I would think I'd at least want to come back and hit this value area. This is where the most time and volume has been spent, so that's where the market's comfortable. Could even want to go up and hit this volume node too. So let's look to just kind of build this strategy around this. So we know we're looking at like 74 and 80 just to give us a ballpark of where we want to kind of set this up. If we are going to do the 84 delta, we don't have an 84 delta, so I'd probably opt for one that's a little bit closer on this one. So let's do the 65 calls here. So we're going to do the 65 calls. We got to pay for about 70 cents of extrinsic value, right? We don't have that 70 cents, so let's opt a little bit lower. This has a 32% chance of getting touched, which is, or actually it's got about a 60% chance of getting touched. It's got a 32% chance of being in the money at expiration. That's what delta tells you. Floor trader hack is 2 times the delta is the probability of it getting touched during this next 52 days. It's only a 32% chance of being in the money by a penny at expiration. So, but on the floor we used to always look at the delta times 2. That was our probability of just being touched. So here we have a $7.50 wide. So we'd want this to be closer to probably $3.50. So let's look at a different one. Maybe we're still bullish. We're probably not going to be able to pay for all of the value on this, but maybe we're really bullish on it. Then that would be where we're kind of picking the at the monies. That's $70 is at the money. So we're going to buy that one, and then we're going to look to go out and probably sell something like, I usually like to go to the 16 delta at least, but 10 delta, let's say. So 7.5. You could even go to the 80, like if you thought it was really going to go to that 81 strike, which was where that value or that node was. Oh, sorry. I want to go to the 80s, which is real close to where that second node was. And then in this case, we got $10 wide. We're paying a debit of $1.88. So I would probably go back down to, because I'm paying $1.88. This is a low risk trade. But my idea with this is to kind of risk 1 to make 2. That's risking 1 to make, what is that, 4? So that's a little bit wide. So let's lower it back down to that 7.5 strike. Try and get that closer to risking 1 to make 2. So that gives us $3.50, right? Yeah, $3.50. So that's $5.25. So we're looking at $7. You might even be able to go just a little bit tighter. See what it does when you go a little bit tighter to get to that parameter of risk 1 to make 2. So now we're at $5 wide. That's pretty close. So that's that's probably where I'd kind of put that. That's still a little bit better, but it's very close to risking 1 to make 2. And now we've increased our probabilities of success. So that seems like the sweet spot for that one to me, if I was pretty bullish on this, to make that money. And then as soon as it goes up there and hits those 75s, then that's probably when I would look to cover it, which is right there at that value area. Goes up and hits 75, I'm going to be looking to cover it. I thought somebody asked about what do the horizontal lines represent on the value area. This is right here, value. This is a value area high, and this has to do with the percentage of this volume. Anytime it gets out of here, it just gets a little bit overdone. There's just not a lot of participation out here is what this is saying with those lines. And this is where the predominant amount, this is basically like one standard deviation out and one standard deviation out here. But this is where the most time and volume has been spent, and this is the exact area where the most time and volume has been spent for the most part. This is where the market finds value. So, you can see that this is pretty close to out here. So if we got just a little bit more time and volume up here, you could see these shift. So that's why I was saying we could look at the 80s, but in the next 50 some days, that's just a very low probability. Okay. Does that answer your questions? Okay, so let's look at Apple. So, because we're running out of time. So Apple, Apple's had a nice big run, and this would be a place where, you can kind of see this volume is kind of trickling off a little bit. It does have low implied volatility. This might be something where, this is your 10% correction or 10% move to the upside easily. So this might be something I would look to short, but that's me. And if you're still really bullish on Apple, let's look at that 84 delta. It's 86. That's as close as we're probably going to get. So buy that one and then look for the 16 delta out of the money. Is that 145? Is that going to pay for our, oh, that'll easily pay for our extrinsic value. So you can look across the 125 calls, got about 50 cents in extrinsic value. I'm selling this 16 delta, that's 78 cents. So when we look at this, we can look at this and say 136.50. So we're literally buying Apple below where it's trading currently. That's good. So we got $20 wide. We're paying a little bit over, even more so than that last example I looked at. We're paying a little bit over that 50%, the width of the strikes. So keep an eye on it. You can play with it if you're wildly bullish. You could look to where the 136 is here. Because this is at the money, this is your extrinsic value, but we're not going to look to pay for that because I'd be selling these, and that's just not going to usually work out. As you can see, although it's $5 wide, you're paying less than that, so that would it's 50%, but we want to try and risk one to make two. So let's move this up a little bit. So let's go to the 45s, the 145s, be clear. And now we got $10 wide. That's closer. It's a little bit over on the upside. I think, but $3.25 would be better. Let's move it up one more just to check, just to double check ourselves. Check all your scenarios because, like I said, you could only do order. The way to set yourself up for success is order entry. So here we have $15 wide. That would be $5. So that would probably be the one if I was really bullish to pick because I'm risking one to make two more. All right. It's a lot to pay in a debit. That's a lot to risk there. But if you're really bullish, that's how you kind of set up with that. All right, so let's look at one that I saw that had a big move yesterday. You guys saw it had basically a 10% correction in one day, and it was basically because Trump met with the CEO and some speculation came out that they weren't going to get, the government wasn't going to do a lot of infrastructure spending, so that hurt U.S. steel. U.S. steel still has better steel than China, so some people say, well, you just buy steel from China. Well, there's a lot of problems with Chinese steel. So U.S. Steel still makes the best. So in that regard, you know, we got basically, we can look at, make sure I got my drawing set up for trend line. So here's a way to check out what your, you know, correction is. So I'm going to go from the bottom because I know that if I go from the top, it's going to go off the screen. See how you want to be able to see it. So let's start from the bottom just so I can get what the percent is on the. So if I go like this and click here, draw a line to the top, you can see, can you see the, did you guys see the percent in there? It was like a 15% move. So remove that drawing. Anyway, so you see how I did that? When you go like this and you draw that line up there, you can see that there's a 14.8% move in that just few days. So that having that 10% correction that I'm looking at, let's look at its implied volatility. And I actually covered my strategy in there because I had, if you guys watched the daily market commentary, I actually did this as a long put spread just a few days ago and got that move out of nowhere and was able to cover it. So if you watch those daily market commentaries, I had that on just a few days ago. All right, so so real quickly, let's look at this because we're running out of time. I'd be looking at the 84 delta. That's this one right here. So the 30 calls, because I think that there's, you know, let's just say I think that there's going to be a rebound, but it could stay right here. So I'm not super bullish, but we're trying to pay 80 cents in extrinsic value. That puts us right around the 46 calls. That should get us that chance. So we're looking at $36.96 as our break even. That puts us below where the current underlying is trading. That's always good. We've got a $16 wide strategy, so it should be paying around, we should be paying around what, $8, and we're getting it for 7. So that fits that rule. We're paying below that value there, so that's great. The other thing we could look at is if you were wildly bullish on this because it made that big move and now you think, oh, it's going to snap back, we buy the at the monies, we're probably going to be looking at selling maybe something like the 16 delta is usually where I look to set this up. So you hold down control and sell those. So now we've got an $11 wide strategy, $2.73. So that's pretty close to that. Oh, that's way over that. Sorry, we'd be looking $3. We're probably looking at well over that. So I'd start ratcheting this down to increase my probabilities of being touched or hitting that strike. So we can move that down. So now we have $8 wide. So $8 wide divided by 3. My brain's going mushy, so that's pretty close. So that'd be, yeah, so 2, 4, 6, 7. So that's pretty close to that. Risk 1 to make 2. It's actually a little bit better than that. You might even be able to ratchet that down a little bit more to find that sweet spot. So what we were talking about earlier, if I did this on a technical move where, you know, this kind of looks like a, you know, a support area because it's come down to this area here. You know, if you played this as a technical analysis trade, I would say as soon as it broke below this, I would be out of it, you know, rather than kind of let this ride off in the sunset. If I was neutral to bullish, then I'd probably let this play out a little bit longer because I want to play it for the long-term stock, if you will, or a stock surrogate, if you will. All right. So did I explain all those different ways pretty thoroughly for you guys? And David, did I answer your question on the do you do long? David, great question. Yes, we're going to be doing the long put spread next week, and it's a little bit easier to set up because the way volatility acts with this strategy. So we'll be doing that next Friday, and I'm going to be doing quite a few of these different spread setups the next couple of weeks. So stay tuned for that. There are some good ones coming down the pipe. So this is the offer we're going to be doing, 2 months for the price of one. It's a great deal for 97 bucks. You guys can probably easily save that money in just a couple of trades. And if you learned anything at all from what I've taught you, saved you time on some of those trader hacks, those things are going to save you time and a lot of headache. That will save you money in the long run, because time is money. If you think I've helped you out with anything at all today and opened your eyes, even if you're a savvy trader, this is a great price. You just know that in less than a week you can spend that in commissions, and if I increase your probabilities of success on one trade alone, which I am sure I have, it's basically one trade out of all of your career. It's a great deal. Basically, you get the daily market commentary videos, you guys. I talk about every single trade. Like I even went over this U.S. steel trade that I did, and I've been doing some covered call, poor man's covered calls, and things of that nature. I go through all those rules, how to manage those, how to stay mechanical, how to defend trades, that I find that you can trade, that you can be mechanical with, maybe say the short iron condor or something like that. Talk about how to be mechanical with that, and I go through everything that I'm doing with those rolling calls, rolling strategies, everything in these daily market commentaries. They're only about 10 minutes long, but I go through geopolitical talk, I go through all the economic data and tell you what I see in that economic data, go through the charts, talk about directionality of different things, and then I go through all my trades. So I go through all of that. Those are hugely valuable in my eyes. And then you also get 50 trading workshops. That's a great deal. This link is in the chat window, you guys. So right here is the link. If you're watching the replay, like some of you had to leave a little bit earlier, you can just pause this and write down this link and then type it into your URL. But if you're still here, the easiest way to do this is to click on that chat window. You also get these videos that I did are like shorter videos, 5-10 minutes, and they're kind of like refresher for some of the strategies that I've done, and go over the rules rather quickly. I don't go through all the charts on the platform, but I try and give you a little bit of refresher course in case you didn't want to watch the whole video again. And you also get the options trading lessons videos in the archives. Those are great. Premium membership trading course. You can receive all of these, and you can have access to me. So you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. If you have any questions, please reach out to us. They also have payment plans if you are looking for a payment plan on something like that as well. All right. Any scraps left for me? Just got here. Rick, what are you doing? They haven't changed the time. There's no excuses. And you can watch the video over on replay. They'll be sending it out. But thanks for joining us, Rick. Are there 50 online trading workshop videos or videos? There's over that. I mean, I think there's, when was the last I checked? I can't remember. There's a lot more than that actually at this point. That's a little bit old. All right, enjoy your weekend too, Rick. Take care, buddy. Yeah, I can't remember exactly how many there are, but there's quite a few at this point, Brian. So reach out to us at Pro Trader Strategies. You can take care of it. All right, does anybody else have any other questions real quick? I just want to remind you, click on the link right here in that chat window on the thing, not necessarily where we've been communicating back and forth on the questions box. I want to thank you guys all for joining us. Later webinars, I'll be drilling down on different options components and options trades I find, when and where I find them appropriate. Also, if you guys have any strategies you want me to look at, I know Larry reached out to me about one. It ended up being one that I had already covered. You just hadn't seen it. But reach out to us. If you want me to cover a strategy, reach out to us and give us some suggestions on things you want us to cover in these webinars, and we'll look into those and do it. This is also the link to that. It is something you'd have to, again, pause, write down, and type it in. Much easier to click on the chat window. And I mentioned our phone number, 310-598-6677, and trading at protraderstrategies.com. Thank you guys all very much, and have a great weekend. Hope you guys learned something from this webinar, and hope to see you guys all at the next few webinars. They will be something you can learn something from, even if you've been trading for years, I'm sure. All right. If you can't take that, take it easy. Thanks, Luke. Thanks, David. Take care, JQ, guys. Brian, thank you.